Welcome to the Opening Bell Report.
We need to look at a set of numbers that, honestly, they just shouldn't exist in a rational market. We are looking at a technology company, a golf tech company, that did nearly $22 million in sales over the last year.
Right. Real sales, not projections. Real money coming in the door.
But, and this is the part that makes no sense, the entire company, as of, January 2026, is valued by the stock market at about $2 million.
Which is, that's a valuation you'd see on a shell company, not a legacy tech player with real 8-figure revenue.
Exactly. We're talking about TRUG Holdings. The ticker is TRUG. Right now, it's trading for about 73 cents a share. And that gives it a price-to-sales ratio of, 0.09?
Yeah, around 0.09x, which is, it's effectively zero. Let's be really clear about what that number implies. The market is pricing this thing for bankruptcy. It's not just cheap or undervalued.
It's priced for liquidation.
Precisely. It's treated as a distressed asset.
And that's the real puzzle we're digging into here. We've got this analysis report in front of us, the 0.1x sales anomaly, and it lays out this picture of a company that is mathematically the cheapest tech stock out there based on sales. But we all know when something is this cheap, it's usually for a very good and very dangerous reason.
Dangerous is, putting it mildly, this is what you call a binary outcome. It's a bet where the stock either goes to zero because the whole thing collapses, or it snaps back to reality to some kind of logical valuation, and it goes up, 500, maybe even 1,000%. There's really no in-between here.
Okay, so let's get into the specifics. Our listeners get price to sales. They don't need the textbook definition. What they need is context. What does the normal company in this space, golf tech, trade for? Someone like Topgolf Callaway.
Well, the sector average is usually somewhere between, say, 1.5 to 3 times sales. Topgolf Callaway, which is ticker MODG, that's really the closest public comparison. And it trades at about 0.9 times sales.
Okay, let's stop right there. 0.9x for Topgolf. But Topgolf is heavy, right? They own real estate, driving ranges, all that physical inventory. TrueGolf is mostly a software company.
Exactly. In any normal market, a software company, especially one with a strong IP moat, should trade at a premium to a hardware or real estate company. The margins are better.
So TrueGolf, with its software, should theoretically trade higher than 0.9x.
It should. Instead, it's trading at a 90% discount to its closest peer.
A 90% discount.
Yeah.
To a company, it should probably be outperforming on a multiple basis. That is the definition of a market dislocation. But, the market isn't dumb. It doesn't price a software company at 0.09x sales just for fun. So what is the catch?
The catch is the balance sheet. And we're going to get into that because, frankly, it is ugly. But before we dive into the cash burn, we have to establish what exactly is being valued at $2 million. Because if the product is junk, then maybe $2 million is generous.
Right, if they're selling $22 million worth of broken VCRs, who cares? But the report really emphasizes that their main asset, this E6 Connect software, it's a big deal.
E6 Connect is the crown jewel. You should think of it as the operating system for golf simulators. It's not just a game. It's a sophisticated physics engine that connects with all sorts of different launch monitors from different companies.
So it's a platform. It's not a closed ecosystem.
That's the key. It's not a walled garden. If you go out and buy a FlightScope launch monitor or a dozen other brands, you're probably running E6 Connect software to see your shot. That gives them stickiness. It's a network effect. The analysis points out that even competitors use TrueGolf's code.
So if TrueGolf, the company, just vanished tomorrow, that software code would still be incredibly valuable. It has a huge user base.
And that is the entire acquisition arbitrage thesis in a nutshell. The argument is simple. The intellectual property alone, just the code for E6 Connect, is worth a lot more than the company's $2 million market cap.
But they're not just sitting on old code. The report says they're trying to pivot. They're moving into franchising with something called True Golf Links.
Right, that's their shot at the whole off-course golf boom that Topgolf really pioneered. They want to create these indoor venues using their own tech, and they're also developing this multiplayer indoor driving range idea.
Sounds great on paper, but pivots like that cost a ton of money. And that brings us to what's happening, right now, the 2026 PGA show.
Yes, happening January 20th to the 23rd. And for them, this is a make-or-break moment. They're supposed to be unveiling a new AI coach and some new sensor tech. Now, AI is a buzzword, we know that, but for golf instruction, an AI that can actually analyze your swing in real time, that could change the product from just a game into an actual training tool.
Which makes it stickier.
Yeah.
It increases the value of a subscription. If I can get real lessons from the software, I'm not going to cancel.
Precisely. If they get a great reception at the PGA show, it proves the tech is still relevant, still on the cutting edge. It shows that despite the stock being in the toilet, the engineers are still innovating.
Okay, but, and here's the dose of reality. None of that great tech matters if you can't afford to keep the lights on. Let's look at the financials. The report calls it the bear case, but it reads more like a horror story.
It's a financial nightmare, really. So, trailing 12 months revenue, about $22 million, that's the good part. The bad part is the operating income is negative $8.6 million.
So for every dollar in sales, they're spending about $1.40 to get it. That's not sustainable.
It gets worse. Go down to the bottom line. Net income, it's negative $19 million.
Wait. How do you go from -8 in operating loss to -19 in net loss? That's a huge jump.
That's all the other stuff. Interest on debt, financing costs, one-time charges. They're not just bleeding cash from running the business, they're bleeding cash from the cost of staying alive. The earnings per share, the EPS, is negative $11.02.
Hold on. The stock is 73 cents, and the loss per share is $11.
Correct. In 1 year, they lost more than 15 times their current share price. That's why the stock has been obliterated. It's a total crisis of confidence. The report highlights that they just kept missing earnings estimates all through 2025.
So the market just gave up. It's saying, we don't trust management, we don't believe the numbers, this is going to zero.
It's a classic broken IPO story. It came public, shot up to over $33 a share, and has now collapsed 97%. When a chart looks like that, you just have this huge cloud of angry investors who will sell on any little bounce.
Which brings us to how they survive. You mentioned financing costs. We have to talk about dilution. Because at 70 cents a share, how do you even raise money to fill a $19 million hole?
And that's the death spiral. To raise just $1 million in cash, they have to print and sell almost 1.5 million new shares at these prices.
Which massively increases the number of shares out there.
Right. And it just crushes the value for existing shareholders. If they need to raise $5 million, they might have to double the float. It's incredibly toxic. It creates a ceiling on the stock because anytime it starts to move up, the company has to sell more shares just to fund operations.
So when you, the listeners, see that 73-cent price, you're not just betting on the tech, you're betting on a race against the clock.
It is a race. Can they fix the cash burn or can they sell the company before the constant dilution makes the shares worthless?
So let's talk about selling the company, the acquisition arbitrage idea. If the IP is really worth so much more than the market cap, why hasn't a bigger player just bought them already?
Well, a couple of reasons. First, M&A is slow. But more importantly, if you're a potential buyer, say you're TrackMan or a Foresight, you see TRUG bleeding out. Why would you offer them $20 million today?
You'd wait.
You wait. You hope they go into Chapter 11 bankruptcy, and then you swoop in and buy the good stuff, the E6 code for pennies on the dollar. $2 million, maybe.
It's a ruthless game of chicken.
Yeah.
But the risk for that buyer is that someone else jumps in first.
Exactly. If TrackMan waits too long, maybe Topgolf makes a move. Or a private equity firm looks at the $22 million in sales and thinks, you know what? The business model is broken, but the demand is real. We can fix this.
Okay, so let's game out the bull case. Someone decides they want the tech now, maybe they're impressed by the PGA show stuff, and they make an offer. What's a realistic buyout price?
Even a lowball fire sale offer completely changes the math for a shareholder. Let's say someone buys TRUG for just 0.5 times sales. That's still a huge discount to its peers.
Half of what Topgolf trades at.
Exactly. That would imply a valuation of around $11 million.
And based on the current shares, that puts the stock price where?
Somewhere around $4 a share.
70 cents to $4. That's a 5-bagger.
And remember, that's the disaster recovery price. If they got buyout at a peer multiple 0.9x sales like Topgolf, you're looking at a share price of over $7.50, a 10x return.
And that's the siren song of these kinds of plays, isn't it? You risk 100% of your capital for a shot at making 500 or 1,000%.
It's venture capital logic in the public markets. Most of these bets go to zero. But the one that hits pays for all the ones that don't. The whole question is whether TRUG has what it takes to be the one that survives.
The analysis report does point to some technical chart patterns that suggest maybe the worst of the selling is over. I know it can be a bit like reading tea leaves, but what's the chart telling us?
It's showing signs of what traders call capitulation. Basically, the sellers are exhausted. We're seeing a falling wedge pattern, which often forms right at the end of a long, painful downtrend. Anyone who wanted to sell in a panic has probably already sold.
And it mentions the RSI is deeply oversold.
Which, statistically suggests a bounce is more likely than not. But the key number the report flags is 63 cents. That's the line in the sand. As long as the stock stays above that level, the technical setup is there for a potential bounce back up to around $1.20.
But there's the liquidity problem too. The float, the number of shares available to trade, is tiny. 1 to 2 million shares.
It's microscopic. That means the volatility is going to be extreme. If any good news comes out of the PGA show and buyers show up, there are simply no shares for sale.
It's a supply shock.
And the price can gap up violently. The report basically predicts 10 to 20% daily moves are possible. This isn't a stock you can just set and forget.
So let's bring it all together. The analysis is very careful not to call this an investment.
It explicitly calls it a gamble. And I think that's the most important distinction for anyone listening. An investment is buying a quality asset to compound over time. This is a special situation. You're buying a burning building because you think the land underneath is worth more than the ashes.
Or, to stick with that, you're buying it because you know there's a fireproof safe inside full of gold, the software code.
Yeah.
And you're betting someone puts the fire out before the safe melts.
That's a better analogy, actually. And the fire department, in this case, is either an acquisition or a miraculous turnaround.
You know, we see these value traps all the time. Chief stocks that just get cheaper. Is there anything about the golf industry itself that makes this situation different?
That's a fair point. The tailwind is actually there. The whole off-course, golf market simulators, entertainment venues, it's growing. The demand for their type of product is real, and it's increasing. This isn't a company selling a product nobody wants anymore.
So the product market fit exists.
Yes. The failure here isn't the product, it's the execution and the financing. And that's a key distinction. Execution risk is often fixable. Relevance risk is not.
A new management team or an acquirer can fix a broken operation. They can't create demand out of thin air.
Exactly. And that's why the acquisition thesis has some merit. A company like TrackMan doesn't care about TruGolf's management. They want the code, the user base, and the brand.
So for the listener looking at TRG, thinking this might be their lottery ticket, what are the absolute red flags to watch for in the next, say, 30 days?
Number one is the PGA show. If the reaction to their new tech is just a collective shrug, that's a huge blow to the bull case. Number two, watch the SEC filings. They have to raise money soon. If they announce a huge toxic financing round selling shares for 50 cents with a ton of warrants, that's a major red flag.
And keep an eye on that 63-cent level on the chart.
If it breaks below 63 cents and stays there, the chart is broken. The odds of it going much, much lower increase dramatically.
It is a high wire act. You know, it's fascinating. We spend so much time on steady, quality companies, but these distressed situations really reveal how the market works at its most brutal edge.
It strips away all the stories and just leaves you with math and game theory. Is the asset worth more than the debt? Can you get it out in time? It's capitalism in its purest form.
It makes you think about what ownership even is. I was thinking about this earlier. If TruGolf goes bankrupt, the shareholders lose everything, wiped out. But the software, E6 Connect, it won't just disappear. Someone will buy it out of bankruptcy, and it'll probably be used for another 2 decades.
And that's the potential tragedy for the person holding the stock. You can be 100% right about the tech. You can say E6 Connect is the future and be correct, but you bought the company, not the code.
And if the company is sick, the quality of the product might not be enough to save you.
A painful lesson, but a necessary one in these kinds of plays.
Well, this is one we will definitely be watching, TRUG. It's either the deal of the decade or it's a zero. Doesn't feel like there's much room in the middle.
I will absolutely watching. I'm not sure I have the stomach for it, but I won't be able to look away.
Me neither. That's a wrap for this deep dive into the 0.1x anomaly. Thanks for listening, manage your risk, and we'll see you on the next one.
Don't forget to like, share, and subscribe for more.